Hello and good evening. Welcome to session 2 of SBL revision for your exam preparation. We'll be covering chapter number 9 to 16 in this session. As I said in the previous session also, we are covering a lot of 8 chapters per session. So this session will target chapter number 9 till chapter number 16 from the Kaplan study text. However, I have taken the contents somewhere from ACCA Study Hub also. But just to locate what part of the syllabus we are covering, I am referring to the Kaplan study text content parts. Coming to chapter number 9 as a kickstart, stakeholders and corporate social responsibility. You won't find much areas to learn here, but there are certain terms which you may get confused on. One, there are many types of stakeholders. There can be primary and secondary, there can be internal and external, there can be legitimate and illegitimate, there can be voluntary and involuntary, there can be active and passive stakeholders, and there can be narrow and wide stakeholders. I'll quickly run through what these are. Primary stakeholders who directly impact the company. Secondary stakeholders, they cannot directly impact the company, they do not have that much power. Then comes narrow and wide stakeholders. Narrow are basically who are very small in number and they are majorly connected with the company. They can be the major shareholders, they can be the employees, they can be the management. Wide are like government, like the community. They are spread widely across the environment in which the business operates. Active and passive stakeholders. Active, who actively participate in the operations of the business. Passive stakeholders, who usually do not actively participate in the business. They are passive stakeholders, not much interested in the business of the company. Then voluntary and involuntary. Voluntary stakeholders choose to get involved in the management of the business, some strategic decision making. They voluntarily come to participate. While involuntary stakeholders, they choose to be they do not get involved in the organizational matters. They choose to be out of the management or the strategic decisions. They want to be left alone. They are involuntary stakeholders. Then legitimate and illegitimate. Legitimate are those who ask for things which are genuine. Illegitimate stakeholders are those whose demands, whose asks, whose expectations are not genuine. We take terrorists, force groups under illegitimate stakeholders. Legitimate stakeholders are maybe the customers, the suppliers, the employees. They are legitimate. If they demand something, it has got a background, it has got some logic, it has got a valid reason behind their demands or expectations from the business. And internal and external stakeholders. Internal stakeholders are a part within the organization. External stakeholders they belong outside to the organization. They can be suppliers, they can be the government, they can be the customers, and internal are the employees, management. They are internal stakeholders of a business. Now, stakeholder claims. Stakeholder claims can be direct claims and indirect claims. Now, remember, why are we taking up this topic is in case you have a question in the exam related to stakeholders, some of the terminologies may be used from here. Their claims, you may have to use the word direct claims and indirect claims. Direct claims are where the stakeholders directly come to the organization and ask for their expected demand. Indirect claims are when the stakeholders are voiceless, they need someone else to represent them. You can say maybe an NGO where a customer, if directly not able to connect with the company, they may come through an NGO, or an NGO may raise the concern from many customers. So that is an indirect claim coming from a stakeholder. Now, stakeholder mapping, the Mendelow's model. Mark this as important because since last few times we have seen this coming in the exam, specifically because a company and specifically its leaders, they need to keep their stakeholders happy, some stakeholders informed, some stakeholders nothing to be done or ignored. That means this decision, what treatment or what type of support or how much entertainment must be done for any stakeholder, that comes with Mendelow's model. So Mendelow's model says it depends upon the power and interest of the stakeholders how a company should treat them. If they are powerful, high power, and they are interested also in the business, that means interest is also high, power is also high with a particular stakeholder, they are highly interested, they are highly powerful, they are the key players of the business. They can be the major shareholders, they can be the trade unions. If today they stop working, the trade unions ask the workers to stop working, the whole production system and the organization will stop. So key players. Then there may be high power with particular stakeholders, but they may be very less interested. They need to be kept satisfied. Institutional investors usually do not interfere too much. They are not too much interested in the operations of the business. What they just want is just keep us informed, just keep us satisfied. Whatever conditions are kept with any particular item for the growth of the business, keep on satisfying those conditions, keep on growing the business. So they just they just want to be satisfied and kept in loop. Now, there are other people, other stakeholders who exert very less power, but they are highly interested in the business. For example, the suppliers. If the business doesn't work, suppliers' business also is gone. So their power is very low. They cannot decide upon how much purchase should be done from the supplier. The company will decide that which product to launch, which product not to launch, company's decision. So their power is very low, but they are highly interested in the business. So here they should be informed whatever plans a business undertakes or whatever plans the business is going to take. And then there are stakeholders who are very less interested, plus they have very less power in their hands. You need to ignore them. In terms, I will say, don't say ignore. Minimum effort must be given towards such stakeholders. Ignoring would not be correct to say. So better to keep minimal effort towards such stakeholders. So Mendelow's matrix, Mendelow's model gave a lot of insight on how to handle stakeholders, to whom the company should focus, to whose demands the company should take lightly. Mendelow's model will answer to this question. Now comes chapter 10, effective leadership. Nothing much here also, but there are 2-3 terms which you need to remember. One, there are two types of leaders, transactional leaders and transformational leaders. Transactional, quickly revise, they are there for business, simply business. And transformational, who motivate the team members for their growth also. They transform a team member into a more talented employee. Now, there are behavioral or leadership style theories. One, there can be an autocratic leader who tells. He just tells what needs to be done and the team has to follow. Then there can be a persuasive leader. He persuades his team, convinces them, tells the team what are the effects, what are the benefits of doing something. So motivates the people, persuades them, and then do as per the action plan. Then participative leader. He let ideas coming from the team members also. Under persuasive, he will try to persuade the team members, but he will not consult them. He will not ask for ideas from the team members. But a participative leader will ask for ideas from the team. And then comes the democratic leader. He does everything with the participation of the people. That means he takes care of the people in terms of what people have to say. People's vote matters, people's views matter. His team is consulted every time, and the decision is taken on the basis of everyone's view. Next comes contingency or contextual theories and situational approach. Now, there will be situations where you cannot identify that this particular style is the best. That means sometimes a leader has to go as per the situation, as per a contingency or as per the context, which requires him to use his judgment to choose which leadership style he should go. So I have written this just for your knowledge and your reading here. that in the context of a situation, in contingency, in a different situation, you may have to opt for a mixture of different leadership styles depending upon what are the needs of the group, what are the needs of the people of the team, what are the task needs. So based on that, you may have to decide that you have to go ahead with a single approach of leadership style, or you can mix 2, 3 and then go ahead. So this is contextual and situational. Remember their words. Now, let's come to chapter number 11, Board of Directors. The major question which every time is revolving around is on the structure of board. Structure of board means, and specifically, diversity, maintaining diversity in the board. The board must be balanced here with the proper mix of non-executive directors and executive directors. That's the most important thing. NEDs must be independent, and there should be one senior independent director every time in the board of directors. Then the members must have knowledge from different industries. They should have a number of contacts with them. They should be aware of the industry, its requirements, how businesses function in this industry. They should have that background in their minds. Then they should have diversity. This is diversity which I was mentioning. Their background, industry knowledge. Do not take everybody having a finance knowledge in the board. You should have someone who knows operations also. You should have someone who knows marketing as well. Somebody who is into data analytics. That means different backgrounds, people from different backgrounds, different expertise, different experiences. They should be there on the board of directors. Women representation must. Diversity doesn't only come in the form of experiences, it does come in the reference of the gender, age, experience, everything. That means we should not hit upon the board of directors focusing only on elderly people. No, nothing like that. There should be a mix of young people as well as elderly people. Young people will have new ideas, innovation, and more friendly with technology. And the elderly generation of board of directors or part of directors, they will have an experience of dealing with new situations. So experience speaks, and when the young directors are there, then innovation speaks. So there should be a mix. But this is really important. Mark this as very important because there has been continuously questions on diversity in the board. Okay, and women representation, ensure women representation does exist here. Now, under the board structure, you have two types of structures. One is a unitary structure and there is two-tier structure. That means a board can have two types of structures, unitary and two-tier. Unitary is a single board. All the executive directors and NEDs are there. Two-tier board means you have a management board and a supervisory board. Management board will take care of the operations. Supervisory board will look for the management board's functioning, how the management board is acting. Then comes threats to the independence of NEDs. Mark it as important. Again, important. Threats to the independence of NEDs. When the NED receive other remuneration from the company besides the director's fees, that means an NED must not receive anything else than the director's remuneration. Nothing at all to the NED. NED holding a close family tie with the directors of the company, other directors. The NED being a significant shareholder. The NED being there on the board for more than 9 years. So a lot of familiarity with the company. That will be the threat. Then material business relation with the company in the last 3 years. Here there can be a situation in the exam that the NED has a major business contract going with the company, but since last 1 year only. So you have to mention that there is a threat to the independence of an NED if this tie is more than last 3 years, or maybe it is in the last 3 years. If this connect happens, then there is a threat of independence. Now, what if this contract with the NED and the company, it was long back, 10 years back? Then it's fine. This point specifically says if in the last 3 years, there is a major business deal going between the NED and the company, then it is a threat to independence of the NED. Okay, in the last 3 years, not for the last 3 years, it is in the last 3 years, if there is any business connect, it is a threat to independence. Then he has been an employee in the last 5 years. For last 5 years is not the condition. In last 5 years, even for few months, he was an employee. There arises a threat to independence of the NED. And then cross directorships in other companies. Cross directorship is where he is sitting as a director on the board of two companies. Two companies, and that too, he is a board of director in one company, and another company also is, let's suppose it can be a parent subsidiary, and he's a board of directors on both, maybe board of directors on the competitors. One director is on the other company's board, and this other company is one of the directors is here on the board. So this cross directorship also creates a threat of independence. Then comes related to the directors. There are two requirements when a director joins a company. One is induction, a type of orientation where he is introduced to the company. Who takes the induction? Company secretary takes the induction. And then comes, for his regular updation of knowledge, comes CPD, continuing professional development. That means CPD should be structured for all the directors so that they are up to date with their knowledge and the industry changes. Then comes conflict of interest of directors. There are many cases under which directors can have a conflict of interest. Number one, they can contract with their own company. Their own company, they are dealing with a contract. So that is definitely a conflict of interest. Substantial property transactions. That means a director is making substantial property transactions, which usually is approved by the shareholders, even if it is approved by the shareholders. But if one particular director is doing that, then it is a conflict of interest. How conflict of interest will arise here? Let's suppose the total assets of a company are $100 million. Let's suppose $100 million. Out of this $100 million, one of the directors signs off and purchases a $70 million land somewhere. Now, what can be the chances? The land was not worth $70 million. He purchased it at a very high price. And who was the seller? His own relative. Just telling you a fictitious case. There have been instances like this where purchase and sale of property transaction for the companies has been done with some self-interest. Okay, so this is another conflict of interest case. Then contract with listed companies. Now what happens if there is any contract between the company and any party? It usually must be approved by the shareholders before the transaction happens. But if the shareholders are not being told and listed companies are contracting amongst each other without telling the shareholders, there can be something fishy the way it was fishy here. Then loans given to directors. A company is not usually allowed to give loans to the directors because these directors will then try to manipulate the books of accounts, or will try to take benefit, or will try to escape, or will try to take more and more loan from the company, and will try to showcase wrong performance to the shareholders. Their honesty will get impacted. That's the thing here. Then various committees to the board who report to the board. There is a nominations committee, there is a remuneration committee, there is a risk committee, there is an audit committee. Now, remunerations committee and audit committee, they have 100% NEDs placed. But here under the nominations committee and risk committee, NEDs must be majority. Remember, remunerations committee and audit committee have 100% non-executive directors. All directors must be NEDs. But when it is nominations or risk committee, majority should be NED. Okay, so just wanted to take this, what are NED strength in all these committees. Audit committee specifically, you need to remember few points, because for you becoming a leader of any company, audit is something which is core to us. Structure of the audit committee, take care of certain points. One, the members must be independent from the management and must all be NEDs. That we have seen 100% NEDs. They should not be part of the management. That means they should not be executive directors in any way. Then, under the UK code, there must be at least 3 NEDs in an audit committee. And as per SOX, members of the audit committee must not be an affiliate or subsidiary of the company. Okay. And any member of the audit committee must not accept any fees other than the remuneration as a director. So just for your revision, any fees other than the remuneration must not be accepted. This is as per SOX. You have to be more concentrating on the UK code, that you should have at least 3 NEDs on audit committee. Then comes the director's remuneration package and the NED's remuneration package. For the director, he can have a basic salary, he can have a bonus, he can have share options, ESOPs, he can have pension, and he can have some benefits in kind. You remember agency costs? For the directors, residual loss was a term which we were using for benefits given to them in kind. They use car, they use bungalows, and these bungalows and cars belong to the company. So the company incurs expenditure on these bungalows and cars which are provided to the directors. These are benefits in kind which we categorize as residual loss under agency costs. Okay. Now, on share options, there are certain conditions when you are issuing share options to directors. Number one, they should be approved by the shareholders. They must not be offered at a discount. Then the vesting period should be at least 3 years later, so that they at least stay with the company for 3 years. The remuneration or ESOPs must be rewarding, not excessive. Then they should have a challenging performance criteria. They should not be given very easy targets, and then they should get this phased. Means, let's suppose 20% of the ESOPs they can exercise after 3 years, then remaining 60% then they can exercise then next year, then remaining they can exercise after another 1 year. So in phases this should be allocated rather than giving them all the ESOPs together. And minimum 3 years must be there in between they exercising their ESOPs. Now let's talk about, okay, pension. Only the basic salary should be pensionable. Remember these points, because I noticed a case where the company was giving making pension for other amounts also. DNS allowance and other allowance also, they were creating a pension for. Only the basic salary can be given as a pension to directors. Then comes NED remuneration. So the UK Corporate Governance Code 2016 applies to it. The board and the shareholders, they decide the remuneration which must be given to NEDs. They should have only basic salary. They can have some share rewards, but no bonus. Remember that. Now, equity-based remuneration can be offered to NEDs, but they should fully vest on the grant date. That means they cannot go ahead with phases. Fully vest on the grant date. The grant date comes, whatever ESOPs have been given to them, give them completely. And then NEDs are not given any performance-related remuneration, or simply speaking, any bonus is not given to them. Now let's come to Chapter 12, reporting to stakeholders. Ideally, in major regions, in major countries, the legal requirement of disclosure to stakeholders is through annual reports and annual accounts. But there are some voluntary disclosures also which companies have started doing now. That means voluntarily, they have opted to disclose more information. One disclosure is mandatory, which they have to do because the law of the land or the regulatory requirements ask them to do so. Voluntarily also, they want to do some disclosures. Now, when and where this disclosure is to be made? This disclosure should be done in general meetings. One is an annual general meeting, another is an extraordinary general meeting. Now, annual general meeting happens every calendar year because it's annual general meeting, and minimum 20 days of notice must be given to the shareholders so that they can arrange for their attendance in the AGM. Minimum 20 working days. And then clear-cut agenda should be sent that this is the purpose for which the meeting is going to be. 21 days notice is required, 20 working days. Okay. Then comes first must be held no more than 18 months after the date of incorporation and no more than 15 months between meetings. Means if the company has now incorporated, the first AGM must happen within 18 months of its incorporation. 2 AGMs, they can have a gap of maximum 15 months, not more than that. That's the maximum gap they can there can be there. That means if one AGM happened on 1st January of a year, next cannot happen on 31st December of that year. The gap between the 2 AGMs will be more than 15 months. Remember these rules. Then all shareholders must be notified and annual accounts must be approved in this meeting. Now, voting will happen in the AGM. On what? The directors' report will be presented to them. The directors will present the accounts of the year. Directors will be reappointed. Auditors may be reappointed. Directors and auditors' remuneration need approval of the shareholders. And then the final dividend, if needs to be paid, that has to be approved. These are the major actions where the voting of the shareholders is needed in an AGM. Then let's move to environmental and social footprint. Environmental footprint, the company operates and impacts the environment. With the environmental footprint, we try to measure that impact of the business on the environment. Social footprint, the organization's impact on the society, means the human capital, the social capital, and the constructed capital. How? Human capital? A factory in a place will impact the health of the nearby people. It will create pollution. It will create some disposal of chemicals in the waters. This is how the health will be impacted, but it will on the same side, it will give employment to them also. That means making these people more skilled, employed, and independent. Then comes social capital, impact on the society. The society as a whole will get developed, infrastructure will improve, and constructed capital will go into, okay, infrastructure will come under constructed capital. Social capital will be on impact on the people. For example, they can be your customers, they can be the surrounding people of NGO, there can be poor people, there can be people who are the suppliers of this company. So human capital will basically lead to the people working with them and the people who are in their factory, basically the workers and the employees. Social capital is the society. Constructed capital is the infrastructure. Just a second, guys. Okay. Then after social footprint, sustainability. Sustainability is very important nowadays, and you may have to define sustainability also. Just remember a simple definition. Sustainability will hit upon when you are doing business, keeping in mind the requirements of the future. That means do not finish off the resources for your present. We need to protect the resources for the future generations. That means doing business which is sustainable, which leaves the resources for the future generations as well. How do we measure sustainability? We have a quotients approach, and then we have a subjective approach also. But the quotients approach is something which we will be using here. Quotients approach is we simply measure how much is the supply of the social capital versus the need for the social capital. Let's suppose we needed 100. This is just a number, 100 of social capital. The supply came to 70. Supply is 70, we need 100. Now the result, let's see the result. If the result is less than 1, that means it's an unsustainable business. You are taking 100 units of social capital to run your business, and in return, supply means what you are giving back as a social capital, that is 70. You are taking 100 units from the society, you are supplying only 70. But if it is reverse, that means you are taking is 100, but giving back is 150. Supply is giving back 150. This is more than 1. That means this is a sustainable business. You are giving more than what you are taking. What you are taking is your need and supply is what you are giving. So this is the quotients approach. Then there is subjective approach also, where certain goals, on the basis of certain goals, you identify if sustainability is achieved or not. These goals are quite subjective. They require a lot of judgment, and we cannot express them as conclusive proof if we are doing a sustainable business or not. That's the problem with sustainability methods. But accounting for sustainability nowadays is happening. We have two systems or methods with which sustainability accounting is being done. One, record the full cost, all environmental costs, include these costs also in the P&L. That is a full cost accounting method. Now, you may have a question, how do I calculate the environmental costs? You are creating dirt in the river. What will be the cost of cleaning it? That is an environmental cost. Club that cost in the P&L. Whatever cost will be required to restore the environment is your environmental cost. Now, what is triple bottom line accounting? Triple bottom line talks about 3 P's. 3 P's. Talk about people, talk about the planet, talk about the profit. That means impact on the people, the business impact on the people, then the entity's impact on the planet, and the profit which a business is making by using the planet and the people. Doing an accounting of this. So these are 3 goals which a business must include in its accounting. How it is impacting the people, how it is impacting the planet, and considering that, calculate the profit. That means the impact on people and planet must be quantified, their values must be calculated, and based on that, the profit figure must be taken out. This is triple bottom line accounting. Now, there will be 2 key terms which you should use while you are handling social and environmental footprint. Social and environmental audits take place now. Sustainability reporting takes place now. Okay, so these are the keywords. Ensure you use them. Then comes integrated reporting. Mark this as another very important feature of today's question paper, integrated reporting. Now, what is integrated reporting? Its word in itself is telling what is integrated reporting. Reporting which integrates many aspects into a single report. We will talk about 6 capitals under integrated reporting: financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital, and natural capital. The interrelationship between these capitals is clearly defined in the integrated report. For a business, what will be the financial capital? How much capital is borrowed by the company? Whatever amount is right now available with them, whatever amount is needed by them. Giving details about the financial numbers. Then manufactured capital, material, machineries, then whatever they are using in the production, that is your manufactured capital. Manufactured capital, can we take buildings also? Yes. Manufactured capital is your, we are not talking about the output only. We are considering under manufactured capital, we are considering even the assets of the business. They are manufactured capital because you are using them. Just a second, guys. Let me just approve this request. Done. Okay. So I was saying manufactured capital must include 2 things. Number 1, your goods. Number 2, your land and building, plant and machinery. That is also manufactured capital, which you are using in the production process. Then comes intellectual capital. Intellect means the knowledge of the employees of the organization. Then human capital means people's health, people's knowledge, people's skill. Then social capital, the institutions which are a part of the society for the organization. They can be schools, colleges, universities. And then the natural capital is the nature within which the business operates. Now, these 6 capitals, they are just used as inputs for the business. Then the business activities are done, operations are done, and outputs are taken out. These outputs again give result in terms of these 6 capitals. You will get profits, that's a financial capital, again you are getting back. Manufactured capital, goods you will be producing. The intellectual, your employees will be more intelligent now. Human capital, your people's skill set will increase, their health will improve. And then the society, you are giving back to the society, and here giving back to the nature. How? Give back to the nature, the point is this. Okay, so an integrated report may not cover all capitals for a business, but it must focus on capitals which a particular entity finds relevant. For a particular business, if nature is something which is a very important capital, it should cover natural capital in its integrated report. Okay, it's not essential that you take care of all the capitals in the integrated report. Now, there are 7 principles of preparing integrated report. Remember them. Number 1, there should be a strategic focus. And when we talk about integrated report, we should talk about the future. Then the information must be connected. We are talking about 6 different capitals. The information connection is must. Stakeholders relationship must be established. Then the materiality should be kept in mind. Do not give anything immaterial. It should be concise. Overflow of information must be avoided here. It should be reliable and complete. It should be comparable and consistent from the previous years. If it is changed, the format is changed every year, it does not allow comparability. So it should be consistently created in the same manner, and it should be comparative. Now, we come to internal controls, chapter number 13. The moment internal controls come into place or come in the question, try to fit in the Turnbull report, because the Turnbull report in the 1999 gave a very crucial guideline framework on effective internal control systems to reduce risk. Internal controls are used by a business to avoid risk only. So Turnbull report gave a framework which provides some guidelines for the directors, how they should implement the internal controls and how they should review the internal controls regularly. That means the first principle was about implementing a sound internal control system. Second principle was talking about the review of effectiveness of internal control system. Keep on reviewing every year. It should not happen that once the sound internal control system is established, then we forget about it. That's not correct practice for maintaining a sound internal control system. Then comes COSO. 1992, COSO gave some internal control objectives, how objectives of the business can be achieved with some internal control aspects. COSO gave some guidelines, some clarity on it. Number 1, the operations of the business must be effective and should be done efficiently. They should bring efficiency in the operations. Financial reporting must be reliable. Applicable laws must be complied with. COSO was majorly focusing on internal control to be an important part of the business so that the business objectives can be reached, while the Turnbull report specifically provided for a framework on internal controls. It told 2 principles. 1, implement a strong internal control system. 2, review it regularly. While COSO was majorly highlighting that internal control is your important part. Internal control supports your business objective achievement. Okay, so try to mention these words, because when it is internal control, at least Turnbull becomes very important point of reference. Then let's come to elements of an effective internal control system. These screenshots, the blue ones, are coming from the Kaplan study text. Very concise, very explanatory. So I took them as it is. Elements of an effective control system. Effective internal control system must allow flow of information which should be communicated at the correct time to the correct level. It should allow for risk assessment. That means the internal control system should identify that if, for example, the door of the warehouse is not locked, there is a chance of theft happening. That means you are assessing the risk which can happen, and accordingly you need to place a internal control here. Then the control environment, overall environment where control needs to be done, because already maybe there are good controls already in place. So you need to understand the control environment also. Then the internal control system must be regularly monitored, and there should be control activities which should be carried on by the management from time to time. Now, fraud risk management strategy. 3 points here, where one more point gets added. One, fraud detection, fraud response, fraud prevention. And the fourth one comes as fraud deterrence. Fraud detection, regularly keep on checking. Then maybe whistleblowers can highlight if there is a fraud. Reconciliations, numbers getting mismatched. These are some of the tactics of fraud detection. Then respond well to the frauds. How? Maybe you can sue the person, you can fire the employee who has done any fraud. There should be policies in place. Then fraud prevention. Now, whatever happened, happened. Do something so that the fraud gets prevented in the future. Creating a anti-fraud culture, making very strict policies on fraud. And then internal control systems being reviewed regularly and then being made more rigorous. These three relate to when we say that fraud should be prevented, it should be identified, how we are going to respond. But there is a term called risk deterrence. Don't let risk to happen. That is risk deterrence. These things will happen once fraud is already done. Deterrence will be hitting upon the point that don't allow any fraud or any risk to cause a loss to you. So deter the risk, deter the fraud. Okay. Then comes information systems for management control. We have management information systems. There are 3 levels for an organization. Operational level, you use transaction processing system. Middle level, you use decision support system so that managers can get some support on making decisions. And the strategic level, it's executive information system, which gives very filtered information for major strategy building. Then information is needed to maintain, to monitor the internal controls and assessing the risk. What is the criteria based on which we say that the information is good, or features of good information? Accurate. Accurate. First, A stands for accurate. Second, C stands for complete. Then cost beneficial. That means the information should be cost beneficial. Information should be complete. Information should be accurate. Information should be user targeted. That means the information should not be a flood which is of no use for the person who wants to use this information. It should be relevant. It should be authoritative. Means it should tell you something. It should exercise that authority, that is, this information is highlighting and telling you something. That's being authoritative. And then timely. It should be given timely. It should be easy to use. So these are general criteria of making information a good information. Use accurate, complete, cost beneficial, user targeted, relevant, authoritative, timely, and easy to use. Okay. Then chapter 14, audit and compliance. Now we'll talk about the independence of the auditor. You would have seen this threats to the auditor's independence in your audit paper. Still, let's just brush them up. Number 1, self-interest. 2, advocacy. 3, intimidation. 4th, self-review. 5th, familiarity. Self-interest, when you are interested in a particular client because you have a self-interest in it. Advocacy, you are promoting the client's business in front of others. Intimidation, you are being threatened. Self-review. You are checking your own work. Familiarity. You are too familiar with the client. All these create a threat to your independence as an auditor. You may not work ethically. There are some other threats to independence also. One, you may have a financial interest in the client. You may have taken loans from the client, or you may have given loan to the client. Close business relationships exist with the client. Family and personal relationships with the client. Too many gifts and too much hospitality being given to you by the client. Then employment with the client. You are seeking an employment maybe. Right now I am working with the CA firm, but probably after this assignment, I will be working as a CEO for them. Then you will not be honest in signing their balance sheet. And then the size of the fees. If it is a very critical and a very material fees client, you may be biased towards the client. Then we come to chapter number 15 and 16 together because they both relate to risk. So I have combined them. There are few terms which you should ensure that you will be using in your answer. One is risk appetite, how much risk a business can take. Appetite relates to your appetite of eating food also. So how much you can take, that is risk appetite. Risk attitude is how the business have been taking risk. That's the overall attitude, overall character of the business. Then comes risk capacity, maximum what we can take. That's risk capacity. Risk strategy. Risk strategy is how the business is going to manage the risk. And residual risk. This risk cannot be managed. Either you have to start living with it or you have to leave it unattended, because this is the risk which is not possible to be mitigated or just avoided. Then when we say risk appetite, a company can be risk averse or a company can be risk seeking. Risk averse is when the company avoids risks. While there can be companies who want to take risk, they are risk takers. So use these words. Now, another favorite question of the examiner. How can you embed risk management in the business? Everybody should be trained enough that how we should take care of the risk, how we should manage risk coming for the business towards the business. It should be made the company's culture. Embedding in the culture of the organization is the only solution by which you can manage your risk well. Risk management must be made as a normal for the organization. People should be well trained, well informed about the various risk categories which can arise for a business. No blame culture should be followed in the organization. People are usually afraid of telling about the risk or any fraud because they see that the blame is definitely going to come back on me. This blame game culture should be demotivated. People should be motivated to respond, to be alert on the risks faced by the organization. So 2-3 terms I have used here. Number one, make it a culture, company's culture. Number two, it should be the normal for a business. The new normal, we say, the new normal for the business should be managing risk. And number three, no blame game culture. Develop this culture in the organization. Risk management will automatically get embedded there. Now, ERM, and this is the COSO cube. So somewhere this cube creates a lot of confusions for many students, how they have to take care of this cube and ERM to manage risk. So this cube has got 3 parts. Just a second, guys. COSO ERM framework, this cube has got 3 parts. One is this, another is this, one is this, another is this, and the third layer is this. Now, first layer, it tells about the objectives of a business, means strategic objectives, objectives related to the operations, that means objectives related to the financial reporting, and then compliance. They want to do perfect compliance, they want to do correct reporting. These are the objectives. Then comes organizational levels. There can be subsidiary, there can be business units, there can be a division, and there can be entity level. These are the organizational levels of the business. And now these are the 8 elements which work, coordinate with layer 1 and layer 2 for managing the risk of the business. Now, internal environment talks about the environment of the business where risk management, risk appetite of the company is defined. Objective setting, if clear objective is set, it is more likely going to ensure better risk management. Event identification, events which can impact the organization, which can cause damage or bring loss to the organization. Risk assessment, assessing what is the risk and how much would be its impact. Risk response, how we will respond to that risk. Control activities, activities putting in place so that the risk can be mitigated. Information and communication, all the strategies, all the plans, all the risk management procedures must be communicated and informed across the organization. And then monitoring if the ERM framework is working well, right? So this framework will have this, you need to learn. 1, it will have 4 objectives, 4 organizational levels, and 8 components which work together for better risk management. Now, the next important thing, the TARA model. T stands for transfer. It can be SARA also, where S becomes sharing, A is avoidance, then R is reduction, and last A is acceptance. That means we are framing some risk management strategies on the basis of the risk, its impact, and its likelihood. Now, which risk to avoid, which is going to be dangerous for you? Do not invest, avoid that risk. Risk reduction, how can you reduce the risk? This risk needs to be taken, but we should reduce it. Pool the risk, minimize the risk, take some steps so that it can be minimized. Join some other company so that the risk can be pooled together. Accept the risk where it is essential and this much is definitely going to happen. This much risk is to be taken anyhow. That is accepting the risk. And then transferring the risk where we have the opportunity of transferring the risk to an insurance company or to a third party, because the impact of the risk is very high. We will be under huge loss if that risk arises. If insurance can happen, take that insurance, right? Now, there is another principle here, ALAP principle, as low as reasonably practicable principle. Sometimes to avoid a risk, the cost of managing the risk becomes too high. The risk will lead to a loss of $1,000. To avoid this risk, to avoid this loss, I have to take any insurance, let's suppose, and that insurance is costing me $2,000. There is no sense of taking this insurance then. So as low as reasonably possible hits upon the cost of risk reduction. This should be lesser than your actual loss. Whatever loss you are going to face, anyways, the cost of managing it should be less. So the ALAP principle says the cost of risk reduction, if it is more than the benefits, then you are in the wrong path. This ideally cost reduction must be less than the benefits which will come from the risk reduction technique. Benefit should be more, then only you should take up that risk management technique. Now, risk maps. Risk maps came in the exam in the last quarter as well as the last to last quarter. So quite important here. We are talking about this somewhere, something like Tara and Sara here. If the impact of a risk is very high and the chance of this risk arising is also very high, avoid such a preposition. Let's suppose we are talking about a project. The impact of loss from the project is very high. High loss can arise and there are high chances that the project will bring high losses. What will you do with the project? Avoid it. Now let's take another project. Chances are very high, but the loss is very low. Chances are very high, that this project will bring a loss, but the loss is very small. Try to reduce it. Then there are very low chances that a loss will happen, and even if it happens, the loss amount is very nominal. Accept such a risk, accept such a project. Then the project risk attached with the project is not very high, quite low. Very less chances that loss will happen in this project. But if it happens, it will be a very high loss. Better to transfer it to some insurer, maybe enter into a partnership so that two people can bear that risk. Enter into franchisee. Some of the risk will go to the franchisee then. So the point is, if the risk, the possibility of risk is high, impact is also high, avoid that particular project, particular preposition. So this is told by risk maps. Now risk map is quite important, and another comes as risk register also. We'll see risk register as well. But before that, let's see risk management by Ainsworth matrix. Here you are going to enter into a new market with a new product. Which is more risky? This is quite risky. Highest risk option where the market is also new and the product is also new. Highest risk preposition is the case of diversification. We have studied this in the first session. Then comes your product is new, but the market is existing. New product will bring risk. So this product development will bring risk. The product is existing, market is also existing, least risk area. You are in your same shoes, same product, same market, minimal risk. But now product is the same, market is new, a bit higher risk because the new market may not accept your product. So there is a small risk. So even with Ainsworth matrix, there can be risk attached to it. Now, how will you quantify the impact of risks? There are many techniques here. I have written them here. I'll just cover their names. One is scenario planning. Two, sensitivity analysis. Then decision trees help you decide on a course of action. Then computer simulations. There are software packages who can identify based on the risk. They can suggest you which project to take up, or it can give you the impact of the risk. Then existing data analysis can tell you the risk, and risk registers, which I just mentioned. So risk register is something we should see and do not miss. It has come many times in the exam related to the contents of the risk register. One, you need to have a title for it. What is the likelihood of the risk? What will be the impact of the risk? Who are the owners of the risk? Who is going to own that? That, okay, I'll take care of this risk. I'll manage this risk. He's the owner of the risk. The date risk was identified. The date risk was last considered. You were discussing that risk someday. So which date you were discussing that? This point relates to that date. Mitigating actions, then overall risk rating, further actions which must be taken in the future. The action lead name, who is responsible for making sure that the future risk avoiding actions are actually put in place. And the due date by which action can be implemented, and then risk level target. This is the maximum risk which we can handle. So you will be rating this risk in numbers. Learn these contents because risk registers sometimes do come in the exam. Now, risk audit. There are stages in risk audit. We term these stages as IARR. The first I stands for identifying the risk. A stands for assess the risk in terms of what will be its consequence and what is the probability of this risk happening. Review. Review what are the controls in place which can avoid this risk. And last, report. Report to the board of directors or to the senior management about where are the controls, what additional controls are needed. So IARR is the stages in risk audit, are the stages in risk audit. Now, assurance map. So assurance map has got 4 lines of defense: line 1, line 2, line 3, line 4. And assurance map, you map which of the lines of defense is working fine. If I say the 4 lines of defense, first line will be the first level where people are working on the day-to-day basis, means your workers who are actually involved in the operations of the business. That's the first line of defense. If any risk arises, these will be the people who will get to know. If machinery breakdown is a risk, these will be the people who will get to know about it, right? So this is the first line of defense. First line of defense, you will identify if they are prepared or not. Is this defense fine or not? You will mark here. Then comes second line of defense. Second line will be an independent body which is not directly contributing to the production, but they are there, like quality control supervisors. So quality control people are there to see if the second line, at the second line, machinery and output is perfectly fine. There is no risk as of now. You will mark here that the level of defense is medium. But here it is high. Workers immediately get to know if there is any risk. Here it will be medium, obviously, because they are not directly involved in that production, but still there is a scope of improvement here. Then the third line of defense, these are the internal audit team. They are not even checking the product. They are just checking after some period of time. Here, see, none. Third line of defense, working well. But here in the first box, it is not working well. That means here you need to improve. Then the fourth line of defense, now the external auditor comes. This external auditor will see, and here we see that the line of defense is quite weak from the fourth line of defense area. The external auditor is not able to make out, not able to identify any machine breakages or any chances of future machine breakages. He is not a machine expert, no? So there we can improve. We can tell the auditor to please have someone who can, like an actuary, who can value and see if the machines, things are working fine. Maybe an independent engineer who can give a certificate on it so that the life of the machine also can be identified. If the value of the machine is correctly identified, this value needs to be put in the balance sheet, right? So the auditor will also be interested in it. So the 4 lines of defense will defend the business from risks coming in. The first line of defense is the workers. At the first level, they will identify if the risk is going to come. Then the second line of defense is the quality supervisors. Third line of defense is the internal audit team. And the fourth line of defense is the external auditors. These lines of defense are rated by businesses to identify which line of defense needs some improvement. And there they focus. So these lines of defense act as a mode for businesses to decide where more strategies must be built to avoid any risk. With this, we complete till chapter number 16, and this is for this session. In the last part of the revision, we'll be covering chapters 17 till end 24. Okay, 24? Yes, 24. So till the end, we'll cover all the chapters from chapter number 17. So till here, do revise. I have taken the pointers where you need to learn certain stuff, not going into too much detail because it's a revision. We cannot touch base upon all the concepts. Otherwise, when you will be revising, you will be getting confused with the details again. So majorly focusing on the important terms which are supposed to be used by you in the exam, plus certain keywords. We say risk appetite. It's not advisable to say the risk which the business can absorb. It's risk appetite. So try using the word specifically which I have used here in the session. These will enable you to score better in the exam. We'll catch up in the next session. Next time, till the time, keep on studying, keep on progressing. Thank you so much and take care.